Canada is a vast land rich in natural resources, including oil, natural gas, and minerals. For years, these resources have acted as a safety cushion for the U.S. economy. However, recent changes in trade policies have put this long-standing relationship to the test. Former U.S. President Donald Trump once imposed, then suspended, tariffs on Canadian goods, creating uncertainty in the trade partnership between the two countries. As a result, Canada has begun shifting its focus toward European and Asian markets. But what does this mean for the U.S.? Could America's global balance of power be at risk if it loses its largest energy supplier right next door? Canada's new trade agreements with the European Union and Asia are making waves in global trade. If its low-cost heavy oil, abundant natural gas, and critical minerals start flowing to Europe and Asia instead of the U.S., could this weaken Washington's economy, job market, and strategic energy position? Or is the Canada-U.S. relationship still too vital to be replaced? Let's explore the global impact of Canada's energy shift. Before we move on, can you give us a like and subscribe to support us? In recent years, the global energy landscape has changed significantly, with Canada at the center of it all. Energy trade with the U.S. has always been crucial for both economies. However, Trump's tariffs disrupted this relationship.
We've been mistreated very badly by many countries, not just Canada.
After a one-month pause, he announced a 25% tariff on Canadian goods, pushing Canada to seek alternative markets. Given that Canada is the largest supplier of U.S. energy imports and the second-largest destination for U.S. energy exports, after Mexico, these tariffs forced Canada to rethink its trade strategy. Although the U.S. is the world's largest oil and gas producer, it still relies on Canada for heavy crude oil to keep its refineries running and its industries powered. In fact, over 50% of U.S. oil imports come from Canada. Additionally, nearly all of the natural gas and electricity imported into the U.S. originates from Canada, making it an essential partner in energy security and price stability. So why is Canada looking elsewhere? Trump's 25% tariffs on Canadian imports, including a 10% tariff on Canadian oil, have upended one of the world's largest free trade relationships. This sudden shift has prompted Canada to diversify its exports, aiming to increase non-U.S. trade by 50% by 2025. Canada sees great potential in the European Union and Asian markets. The EU is one of the world's largest economies and Canada's second-largest trading partner. In 2016, Canada and the EU signed the Comprehensive Economic and Trade Agreement (CETA), which eliminates tariffs on nearly all goods and provides Canadian businesses with preferential access to European markets. This deal allows Canadian companies to compete for contracts across the EU's 27 member states, opening up a market worth $3.3 trillion. What would happen if Canada redirected its energy exports to Europe and Asia? For the U.S., this could mean losing its privileged access to reliable and affordable energy, leading to higher costs and uncertainty in supply security. Canada's efforts to expand its energy exports have led to new trade agreements with several countries. However, securing a solid deal with the U.S. remains critical. With U.S. tariffs putting pressure on Canada's economy, Canada must remind Washington that its energy and economic security are deeply tied to Canada's resources. A focus on key commodities could drive Canada's economic growth, attract foreign investment, and make Canada an even more crucial partner to the U.S. Expanding trade relationships would also help Canada reduce its dependence on the U.S., while at the same time strengthening its position in global markets. Increasing energy exports to Europe and Asia could open doors for new trade opportunities with some of the world's fastest-growing economies. Interestingly, the U.S. acknowledges Canada's importance. While it imposed a 25% tariff on most imports, Canadian energy only faced a 10% tariff, an indirect admission of its strategic value to American interests. So, how does Canadian oil and gas support U.S. domestic and foreign energy strategies? By supplying a steady flow of energy, Canada helps lower U.S. consumer costs and stabilize energy reserves. While Canada is working to strengthen its trade ties with Europe and Asia, challenges remain. The 25% U.S. tariffs on steel and aluminum have highlighted the risks of relying too heavily on one trading partner. Finding new markets is crucial for Canada's economic future. Expanding resource exports would not only reduce risks for Canada, but also enhance its trade relationships with major global players. Over time, this could lead to more diversified trade and investment opportunities. The US has long recognized Canada's resource strength. Its decision to impose lower tariffs on Canadian energy, compared to other commodities, shows that it still values this crucial trade relationship. As the world's energy landscape shifts, Canada must balance strengthening its position in global markets while maintaining its strategic partnership with the US. The question remains, will the US adjust its approach to keep Canada as its primary energy supplier, or will Canada's future lie elsewhere? What do you think about this shift in Canada-US trade relations? Do you believe Canada will move away from the US as its main energy partner? Let us know your thoughts in the comments below. And don't forget to like this video and subscribe to our channel for more updates on global trade and politics.